Today was another wild one for Opendoor. After several days of relentless volatility and headline-driven momentum, the stock finally ran into some heavy selling pressure. Opendoor closed Wednesday down about 40 cents, or roughly 11%, finishing the day at $3.22 per share. For a stock that only a day earlier had spiked to $4.10, today's decline was a sharp reminder that no rally ever moves in a straight line. But as much as that headline number may look dramatic, it's worth slowing down and unpacking what really happened today. Because underneath the surface, the story of Opendoor is still very much alive, and if anything, days like this can sometimes reveal more about a stock's future than days where it does nothing but climb. Let's start with the trading itself. Wednesday's session was defined by weakness almost from the opening bell. After Tuesday's fireworks, where the stock rocketed as high as $4.10 before sliding back, the market seemed ready for a reset. And that's exactly what happened. Sellers stepped in early, and Opendoor drifted lower throughout the day, spending most of the afternoon trading in the low $3.20s before closing almost exactly on its session lows. Now, some people might look at an 11% sell-off and panic. But it's important to zoom out. Over the past week, Opendoor has staged a massive run from the mid-$2s to over $4 at Tuesday's peak. In percentage terms, that's more than a 50% move in just a handful of sessions. Stocks rarely go parabolic like that without eventually cooling off, and today's action looked, in many ways, like a necessary exhale. The real question is where the base gets established. We've talked before about $3.50 acting as an important support level. On Tuesday, that held beautifully when the stock consolidated in the $3.40 to $3.50 zone. But after today's drop, we now need to ask, is $3.20 the new floor? Or do we risk another test of the round $3 mark if sentiment wavers further? To understand today's move, you also have to place it within the broader market context. US equities were softer overall on Wednesday, with investors treading carefully ahead of the annual Jackson Hole Symposium. This is the marquee gathering of central bankers and economists, and it's often the site of big policy signals. All eyes are on Jerome Powell's speech, which will come later this week, and the stakes are particularly high right now. Why? Because the market is still trying to answer the question of when the Federal Reserve will finally start cutting interest rates. Many traders have circled September as the earliest realistic chance for a cut. But Powell's comments could either firm up that expectation or pour cold water on it. And for a company like Opendoor, which lives and dies by the housing market, this matters immensely. Lower borrowing costs don't just make mortgages cheaper for buyers, they increase housing turnover, they improve affordability, and they lubricate the very transactions that Opendoor depends on. When money is cheaper, more people move, and more people sell their homes. That's Opendoor's sweet spot. So, as Jackson Hole looms, investors are naturally skittish. A hawkish Powell would make stocks like Opendoor vulnerable. A dovish Powell, on the other hand, could send them flying again. That uncertainty was hanging over today's session, and it likely contributed to the sharper pullback. Now let's pivot to what's been perhaps the most fascinating part of the Opendoor story over the past 2 weeks, the surge of retail investor activity. This isn't just about a stock moving higher. It's about a community forming around a company and actively trying to shape its destiny. Anthony Pompliano summed it up brilliantly this week when he described retail as functioning like a decentralized hedge fund. His point was simple: retail investors are no longer just passive holders of stock. They're acting like a hive-mind, pooling their ideas, surfacing opportunities, and applying collective pressure on companies. We've seen this with Opendoor in spades. Hundreds of product suggestions being sent directly to management. Constant social media engagement on X. Retail voices not only celebrating gains but actively proposing strategic shifts, potential M&A targets, and even new leadership options. Eric Jackson has been at the center of this movement, not just calling for bold price targets but now openly floating the idea of Travis Kalanick, the founder and former CEO of Uber, stepping in to run Opendoor. That's not a subtle suggestion. That's a rallying cry for dramatic change at the top. And while there's been no formal response, the fact that conversations like this are happening publicly tells you how much the narrative has shifted. At the same time, you've got Shrisha, Opendoor's interim leader, leaning into the dialogue. He's been visible, he's been communicative, and he's been willing to engage retail investors directly. That matters. Because one of the biggest complaints retail often has is that management teams ignore them. Here, we're seeing the opposite. And that's one reason why even on a day like today, with the stock down double digits, you don't see the same despair that might normally set in. A big question hanging over all of this is whether Opendoor should be considered a meme stock. The term meme stock has often been used pejoratively, as if these names are all hype and no substance. But Pompliano pushed back on that characterization directly, arguing that people who call Opendoor a meme stock simply don't understand what's happening. And he has a point. Yes, retail enthusiasm is a big part of the story. But Opendoor is also a real company with a massive addressable market. Housing is the largest asset class in the world. And the company is still fundamentally experimenting with how to digitize and simplify one of the most important transactions most people ever make. That's not vaporware. That's a real business challenge, and one that could be transformative if solved at scale. So while Opendoor shares characteristics with other retail favorites, high short interest, wild volatility, passionate online communities, it also has a business model with real upside. The trick, of course, is execution. Can the company actually evolve from an asset-heavy iBuyer into the Airbnb of real estate, as Eric Jackson envisions? That's the billion-dollar question. So where does all this leave us? Heading into Thursday's trade, a few key levels and catalysts are front of mind. First, support. Can $3.20 hold? If it breaks, watch the $3 line closely. That's the next psychological and technical level of interest. On the upside, the stock needs to reclaim $3.50 to start rebuilding confidence in the bull case. Second, macro catalysts. The Jackson Hole Symposium could very well set the tone for the next leg of this trade. If Powell signals rate cuts are coming sooner rather than later, expect real estate stocks like Opendoor to catch a strong bid. If he leans hawkish, brace for more chop. Third, the retail narrative. This is a force that simply can't be ignored anymore. Whether it's Eric Jackson's bold calls, Pompliano's framing of retail as a decentralized hedge fund, or Shrisha's ongoing engagement, the retail hive-mind is here and it's active. And as long as that energy persists, Opendoor will remain in the spotlight. In summary, Wednesday's 11% drop in Opendoor may look dramatic, but it needs to be seen in the proper context. After a blistering multi-day rally, a pullback was inevitable. What matters now is whether the base holds, whether the macro backdrop at Jackson Hole delivers relief, and whether the retail movement can keep translating passion into staying power. If you're watching this story unfold, don't get whiplash from the day-to-day price moves. Instead, keep your eyes on the bigger picture. A new model of investor activism is playing out in real time, and Opendoor is the test case. Whether this ends up as a short-lived burst of hype or the early stages of something transformative remains to be seen. But one thing's for sure, this is a stock, and a story, that's not going quietly.